Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Short Verticals, and today we're going to be focusing on charts. We're going to be talking about how a spread trader might use three different technical indicators and combine them into one spread trading approach. And they're actually not entirely different. We're actually going to be using three linear regression lines for planning and placing a vertical spread trade. We'll talk about the management of that spread, a lot to cover. Before we get to any of that, though, let me first of all say hello to everybody out there in YouTube, chatting in already. Great to see some familiar names. I know that I'm the sort of the interloper here today. I'm filling in for Brett while he's out of the office. But hello there to everybody joining, whether you're new or you're a returning veteran. Great to see Life in the Fast Lane. We have Waylon, Wacky Whack. We have Mighty Quinn. See who else is here? Josh, great to see you. Greg, everybody else, thanks for joining us week after week. We do appreciate your attendance and your contributions to these discussions. If you're watching on the YouTube archive after the live stream is concluded, well, enjoy the recordings. Great way to watch these webcasts. But you're certainly invited to join us in the live stream. This is a Thursday webcast series, and we kick things off promptly at 2 Eastern time. And I also want to let my live stream audience members know that my very good friend Scott Thompson is going to be hanging out in the chats with us today all the way through the discussion. He's going to be keeping an eye on any questions that I can't get to during the presentation, and he'll be picking up my slack for me. So thanks for having my back there, Scott. Scott and I would also like to issue an invitation to everybody watching to follow your favorite Schwab presenters on social media. You can find us on X, you can find us on LinkedIn. You can find Scott and me on X. Find Scott there at Scott Thompson CS. You can find me on X. Give me a follow at Cameron May CS. And if you pop over to LinkedIn, you go to linkedin.com/in and then /Cameron May CS, and you'll find me there as well. But let's get into this discussion. We're talking about using charts to plan and place spread trades. But before we do that, of course, we have to consider the risks associated with doing this sort of thing. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set the agenda for today's discussion. The first thing that I want to do is have a look at what's going on with the markets, but we're going to be looking at market conditions through a fairly specific technical lens. Markets have been pulling back, even through pretty much up to this moment, coming down from recent highs. But I think for spread traders and for other types of traders, common question, how far down might markets fall before they find a little bit of support, start to rise again? Maybe for the bulls that might open a new window of opportunity. Well, we're going to be using a combination of three linear regression lines that sometimes, this is an approach that's sometimes used by technical traders to gauge how far back markets might pull, and then to use the same set of technical indicators to plan and place something like a vertical spread trade. So I think this is going to be an interesting discussion. We'll also include in our discussion an actual example trade with a plan for taking profits if they emerge or try to mitigate the losses. So let's go right to it. Let's go have a look at the S&P 500. Here it is. Here's a quick review of what's been happening with those markets. We hit a peak all-time high on the S&P not very long ago. It's June 25th as of the recording of this webcast. And it was actually June 2nd when we hit that all-time high. But we've kind of pulled back. And I think for some, they might be wondering, well, is the selling going to continue? Are we hitting a bottom? How might we gauge that? Has the trend itself changed? Or is this just sort of a reversion to the mean after a really strong move? That's an interesting I've kind of used that phrase deliberately because we are going to be using a technical indicator to gauge those sorts of things. So let's first of all, let's use our linear regression lines. Now, with 85 people watching the live stream, just give me a quick yes or no. Just a Y will suffice, or an N for no. Are you familiar with linear regression lines, the concept of what they are? And do you understand how they might be used in a sort of a trading scenario? Just a quick yes or no, but as you do that, let's add a linear regression line. And I'm actually going to add three lines. It's actually a series of total of 5. It's 3 studies with 5 lines total. And I'm just going to layer those right on. So I'm going to come up here to the little flask icon, click on our little flask. I'm going to come over to our available studies and type in the word linear. And these are the 3 that I'm going to use. There are actually a total of what, 8 different studies that we might use. The one I'm going to use to build our sort of custom trading strategy today is going to be the linear regression trend line, the linear regression channel 50, and the linear regression channel 100. All right, so let's highlight the linear regression trend line. We're going to add that to our chart. So there it is. Let's highlight the linear regression channel 50 and add that to our chart. There it is. Let's highlight the linear regression channel 100 and add that to our chart. And as I build that up, I see a lot of people said yes, but there are plenty of people also said no. Now, anytime I get into the world of technical analysis, some of these things can be pretty darn complicated. In my view, these ones are fairly straightforward, all 3. I think I can explain them pretty quickly in a way that just about anybody can follow. So let's apply these to our chart and click OK. And what you'll notice we're left with are these 5 lines stacked on top of one another. So running right through the center of those 5, that's our first line. That's what we call our trend line. And it might accomplish a couple of things for a technical trader. Number one, it might help to determine over a given time frame, give us a gauge of what the general trend is. Is it a guarantee? Is it a perfect definition of the trend? No. But you'll notice in this case, moving left to right over the last 12 months, our linear regression trend line is moving upward, left to right. That's not a huge insight for the S&P having had a great last 12 months, but there can still be a question for some. You know, we're seeing lower highs here as the trend line shifted, as the trend itself shifted. Well, maybe for the technical trader here, with this upward slope and values, in this case, the levels of the S&P still being above that trend line, we might say it looks like an intact trend. Another thing that it might do is establish what we might call normal, average, or the mean. So I used a phrase earlier, a regression to the mean. What that really implies is a return to quote unquote normal. With the S&P 500, as it's chugging away, going up or going down, some investors might see an extreme move to the upside or an extreme move to the downside as temporary. And when we get a strong move in one direction or the other, maybe there's going to be a return to where normal is. But the problem is there's not a strict definition of normal on a chart that just sort of moves all over the place. So what this trend line does is the system automatically draws a line that's intended to split right down the middle of all the price activity for our chart for the time frame of the chart. So it's intended here to get to as close to as many ticks on the chart as possible with just a single line. So it's going to tend to bisect the chart right down the middle. And if you look at this, it looks like it's doing a pretty good job. It's getting right through the center of much of the price activity here. And it's also, you'll see about half of price above, half of price below. So that's what that linear regression line is doing. It's attempting to establish a normal. Because if we're expecting a return to normal, we have to know where normal is. So then what are these other 2 lines? So we have the 50 and the 100. I'm going to go to the 100. So there are actually 2 of them. Notice there are 2 red lines. Those are our 2 linear regression channel 100 lines. And then there are 2 green lines. Those are our linear regression channel 50. Big, long, elaborate name. All these are pretty, it's fairly visually obvious. If we have our center line, our normal, well, these are just parallel lines drawn a prescribed distance from normal. So how do we come up with this linear regression 100? Well, we look over where that trend line was drawn, the center line, and then we look for the closing value for the whole time frame that was the furthest from that line. And on the S&P 500, that's fairly obvious. The biggest move taking us the further away from quote unquote normal was right here where we closed. What was the close right there? That was a close of 63.43.72. That was the biggest departure from the mean or from the average. And so the trader might be looking for a reversal or reversion to that average. Kind of interesting. Looks like we kind of dashed back there. And once we got back to that average, it looks like investors and traders were kind of satisfied being there for a moment. So that's the linear regression channel 100. What do you suppose, or if you want to think of it this way, it's basically capturing 100% of all of the closes for the entire time frame of the chart for the last year in this case. What do you suppose the 50 is? Yep, it's just halfway between the trend line and 100. So departures going the furthest distance for the entire time frame of the chart are pretty unusual. It happens about once per chart, right? Sometimes you can get a couple that are essentially equivalent. More commonly, we might get a 50% departure. And look at what's happened pretty close right here on the S&P and just about dead on just a few weeks ago. So for this linear regression trader who's looking for a reversion to the mean, they might be looking for that next big event. And look what we've had just over the last month. Back there on June 2nd, we got to the 50% level, departure from average. At that point, our trader might be saying, you know what, if I was planning to do let's say buy some more stocks or do a new bullish vertical spread, we're kind of lofty. The air is getting a little thin up here. Maybe there's going to be a reversion to the mean. So for a bullish trader, commonly they'll look for prices to come back down to the trend line. Now, there are going to be other times when they're trading between the 50 and the 100. There are going to be other times when they're trading between the minus 50 and the minus 100. These 5 lines actually divide up the chart into 4 sectors, and those are commonly traded as support and resistance zones. So how's that for a backdrop? It took me, what do you think, about 6 or 7 minutes to explain all 3 of our linear regression lines. So with that representing the full amount of your experience with this, how do you conceive a trader might start to structure, let's say, a bullish vertical spread? That's what we're going to be doing today. I know the markets have been coming back, but let's say that our trader is actually looking for potential new bullish opportunities as prices have come down. Well, yeah, they might look for the S&P, first of all, to come down and settle on one of these linear regression lines. In this case, it happens to be the middle line. Greg says, can this be associated with a type of a Fibonacci retracement? Greg, it is kind of a similar concept, entirely different though in its construction though. With Fibonacci's, it's really up to the trader's discretion where they apply the Fibonacci's and over what time frame. With linear regression, we just put the linear regression on the chart and it's automatically drawn. Wacky Wack says, so isn't the reversion of the mean more or less between the 50 and 200-day moving average? Not always, not always. There can be a strong correlation at times. At other times, the mean might be, or the 50 or the 200 might be in entirely different positions from where the linear regression line is. But the concept is the same. With moving averages, commonly we'll use those as support and resistance. With linear regression, commonly we'll use those as support and resistance. Am I saying that one is inherently superior to the other? Nope. I think that there are just certain fans of one approach and they trade that way. There are fans of another approach and they trade that way. I think maybe the important element of that is to be consistent with one's approach, have discipline, see if it works. All right, so here we find ourselves sitting right at what we might call normal according to the last 12 months. And let's say that it's our spread traders' expectation that prices are likely to rise from here. That can set up a nice scenario. Let's look out here to maybe this next monthly expiration. The July 17th is the next third Friday of the month expiration. Those are the contracts that tend to have the greatest liquidity, the greatest amount of trading volume. So I'm going to focus on those for today's for today's spread. Let's build a spread for July 17th, but we're going to take this new knowledge that we've just gained and let's go apply it to a stock. Now, I've gone through and looked at a bunch of stocks, and I want to maybe push the comfort zone of some who are watching right now. And I also want to show you that these linear regression lines can be used at other levels. So I'm going to switch this over to Walmart. What's been going on with Walmart? Well, Walmart's had a pretty good year. Looking left to right again, our linear regression line is going up. So what might be the trend of Walmart for someone who uses linear regression? Well, they might see this as still an upward trend despite this strong sell-off that we had over the course of a couple of weeks right there from, what was that, May 19th to June 2nd. That's interesting. June 2nd is where Walmart hit its low, and that was the moment when the rest of the market was hitting highs. Interesting. But the concept here is essentially the same. If the trader is looking for bullish entries, they might still look to trade the linear regression lines as support and the resistance. But in this case, we're using the minus 100. Now that might feel bearish, but as long as those are still upward sloping, as we touch off that minus 100, just as we did recently, that may be seen as a potential support area. So I'm going to set this up as an example potential bullish entry. But I also want to structure this trade so that if it doesn't work out, because we're not guaranteed, just because we've gone to the work to add some indicators to our chart, and we've done our best in interpreting what those indicators might have to say for us, not a guarantee that the stock is actually going to cooperate and we're going to turn this into a profitable trade. So we're going to set up a vertical spread that stands to make money if the stock goes up, and we're going to have an order in place to take profits if they materialize. We're also going to have an order in place in case the trade doesn't work out. But it looks like our linear regression is right there around 115. Do you see that? Let me draw in a line at 115 right from today. Let's take that out to expiration right there. Let's set up a vertical spread at that 115 level. If we assume that price is going to go up, how about we set up a spread that is set to be optimized if the stock just stays above, or even if it dips down below, if it goes back up above 115 come July 17th. Now, let's also look, and I haven't looked at the option chain. Let me take a peek over here at Walmart, see what's available for July 17th. And we do have dollar increments here. So what if we turn this, what if we do, let's do a $3 wide spread today. I'll sometimes do 2, I'll sometimes do 5. Let's talk about a $3 wide spread. So that would be 105 or 115 and 112. Shall I be precise here? Let me draw on these lines. And when you've drawn a line on your chart, you can right click on it, edit its properties. And I like to make these precise. So let's just make this one exactly 115. Let's make this one, let's edit the properties of that one and make it exactly 112. And what that does is it just gives us a visual reference point with where we want to be. And with this trade, we're going to want to be up here somewhere. Doesn't matter where, just higher. Just above 115. Where we don't want to be is down here. That's kind of our no-fly zone. So let's edit the properties of that. How about we just call this kind of a peachy color. It's going to look pink to you. There we go. So there's the trade. Let's go see what we might make from this. Let's go to our Walmart option chain, and here's the trade we're outlining. Our example trade is, let's do a bull put spread. So really this one starts with selling a put. Selling a put is a bullish strategy. So if we sell the 115 put, looks like that's trading around maybe $2, $2.05. Let's say we sell the 17th of July. 115 put for 205. And at the same time, no, it's not 205. What am I thinking? 115. I was thinking price. Well, it was 205. Yeah, I'm getting ahead of myself. There we go. That's it. In any case, we're looking to sell that 115 put for 205. And at the same time, to create the bull put spread, we're going to buy, let's say the 113. Let's do the 17th of July. No, 112. We're going to do this $3 wide. How much is that 112 trading for? 105 to 112. Let's say that we get 108. You know what? I'm going to be a little bit less generous. Let's just call it 105. Wacky whack, my apologies. I probably won't have time for that today. But here's going to be our vertical spread. So what does this do? What does it accomplish for us? How do we hope that it works out? Well, what we're doing is we're accepting a premium, a payment of 205, but we're taking on an obligation. Through the 17th of July, someone has the right to sell shares to us, to put those shares into our account for $115. And if we get sold those shares and we want to get rid of them, we also have the contractual right to sell those shares to someone else for 112. It's not that we want to buy at 115 and sell at 112. It's just that's sort of the worst case scenario. Now, for setting that trade up, we're collecting 205, but we're also spending 105. So what's the net credit or the theoretical maximum gain of this trade? That is $1. 205 collected, $1 spent, leaves us with a net credit of $1. What's the theoretical maximum loss? Well, if we do put the shares for 115 and we wind up selling them for 112, that would be a $3 loss. And we could subtract the $1 that we collected up front, but that would leave us with max loss of $2. All right. So we're going to try to optimize this. We're going to try to minimize that. But right from the start, this trade is kind of where it needs to be already. What we're hoping for is for the stock to be above 115 as we get toward the 17th of July, and actually get all the way to 17th of July is usually the scenario that produces the best outcome if we're in the right place. Because if the stock is up here, if the stock is up in this green zone, let's say it's up there at 120, and someone has the right to sell us shares for 115, they're probably not going to do it. They say, Cameron, I'm not selling you my shares for less than they're worth. So we keep the 205. We also don't wind up selling shares to anyone else for 112 because they're worth more than that. So the 105 that we spent for this put just expires worthless, and we realize our maximum gain. So we want to be up here. Well, and Mark's saying, take a look at the cone of probability. Oh, you're talking with somebody else. Yeah, I was thinking, oh boy, I'm not going to be able to go that far, Mark. But the side discussions I really like. Thanks for doing that. Anyway, I'll let you get back to it. Anyway, our theoretical maximum loss. If we're down here below 112 and someone has the right to sell us shares for 115, yeah, they're probably going to do that. They sell us those shares for 115. If we don't want those shares, best we can do is sell them for 112 in that scenario. And that would be a $3 loss, which is only modestly compensated for the credit we originally received. And that's our max loss territory. All right. So let's put in some orders to try to optimize the upside and minimize the downside. Now, neither one of these are going to be guaranteed to be the outcome, but let's place our trade. All right, so here we are, 17th of July. One quick way to do this. There are a couple of ways that we can enter an order. I'll show one of them. We can hold down the control key on our keyboard and just start clicking. So if I'm holding down the control key and I click on the bid price for the contract I intend to sell, that creates a sell order. And then if I minimize that order and click on the ask price, for the contract I intend to buy, it stacks those one on top of each other in that order screen, builds that vertical spread. So that's one way that we could start to build this put spread. Look at that, 95 cents. We were projecting maybe $1. That might be a little bit generous at this point. There's another way that we could do that. Tell me if you've used this technique before. We can go up to spread single. It's showing us all of the single strikes. And instead, I'm going to go to deep and wide and choose 1 month. Both of our contracts are in the same month, 17th of July. But I'm going to choose 3 strikes apart. So if I then choose vertical there, notice it pairs up the 112 with the 115, and I can just click on the bid price, and that creates that vertical spread. Doesn't matter which way we go. It's not like there's a savings or anything like that to do one or the other. But it looks like our credit has shrunk a bit. Let's see if we can get 90 cents for this. So instead of $1, let me just modify my math a little bit. Let's say we only get $2 instead of 205, and we have to spend $1.10 instead of just $1.05. That would give us our net credit. Looks like that's what it might be at this moment, of 90 cents. It would give us a theoretical loss of 210. Double check my math. If I ever forget to adjust something appropriately, let me know. Somebody's following along at home. Don't tell me whether it's paper or real. I'm not trying to give investment advice here, but it looks like they got a $1 credit. I don't know what I'm going to get for this one. But what we need to do before we put this order in, let's think toward the other end of the trade. It might work, might not. We've done our best with the chart. We'll see if that linear regression plan works out. But what's the trader's hope? Well, when we receive a premium, we're hoping that we can spend less than that to close the trade out. So if we're collecting 90 cents, maybe we're trying to spend 10 cents, 20 cents to close this thing out and keep most of it. So here's what I'm going to do. Well, actually, let's talk about the other side of the coin. What we're hoping doesn't happen is that this trade starts to get more expensive to get out. We know that that $3 is out there hanging over our heads is essentially the theoretical worst case scenario. So maybe we might want to try to stop the bleeding if it's going in the wrong direction. So here's what we're going to do. Instead of just placing this one order, let's change this from a single order to a first triggers an OCO order. That's going to allow us to put in 2 exit orders that are dependent. They don't go into effect unless the first order fills, or in other words, that first order triggers the 2 exit orders. So once we've selected that, I'm going to right click on the original order and create an opposite order for taking profits. And I'm going to right click on the original order and create an opposite order for taking losses. So this first one doesn't matter. We could do them in either order. It doesn't matter. But how about we make this first one our profit taker? And let's say we're trying to get in for 90 cents. Let's say we don't want to spend more than 18 cents to get out. Why did I choose 18 cents? Well, that's actually 20% of the original credit received, assuming we get a 90-cent credit. If we collect 90 cents to get in and we only spend 18 cents to close it up, that means we kept 72 cents, which is 80% of the original credit. That's just as an example. Some people might be fine with keeping only half of what was originally collected. Others might try to push it all the way to expiration, try to keep it all. Now, that's if the thing works out like we planned, if it's fun outcome. Let's talk about what's not as fun. Let's suppose it starts getting more expensive to close this trade out. That probably means the stock is going down instead of going up. Puts are becoming more expensive rather than less expensive. So you might think, well, where should we put this exit down here? This is going to be our stop order. Stop the bleeding. This is a buy stop order because we sold to get into the trade. We're buying to stop the bleeding. And one common approach, it's not the approach, it is an approach, is to risk double what one collected as a premium. So what if I put in $1.80? and I make that good till canceled, right? You might be saying, well, Cameron, so if this works out, I make 72 cents. If it doesn't, if I collected 90 cents and I have to exit for 180, that means I lost 90 cents. That's a bigger loss potential than reward potential. That's true. That's true. But if we didn't do either of these plans, what would be the risk and reward potential? Well, there's our reward, 90 cents. Risk is 210. Structured this way, with no plan for exit, there's more than twice the loss potential. Now, I also have to acknowledge, Cia says this is a steep loss. With traders who are setting up a trade up front that is inherently a high probability trade, they may be willing to take a larger loss in pursuit of a proportionally smaller gain. It would be like, let's say, we're just rolling dice. Let's say we have a three-sided die. Not physically possible, but that's what we're going to have, okay? And here's the deal. We're going to roll the dice, and 2 out of 3 times, it might come up a winner, but it's going to create smaller wins. 1 out of 3 times, it's going to come up a loss. It's going to be a larger loss, though. Well, the combination of the two smaller may add up over time to a productive outcome, depending on the deal. But that's it. The odds in that case might be 67% chance of winning, but when we do win, it's a smaller win. Does that make sense? Yep. With vertical spreads like this, we might be willing to settle for a smaller win versus the loss. Okay, definitely want to emphasize here that whenever we use a stop order, it's not a guarantee that that stop is exactly how much risk we're taking on. So in this case, we may have to pay more than $1.80 if the stock is falling hard enough. All right, but let's place this order. Let's click confirm and send. We're attempting to sell this vertical spread, that $3 wide vertical spread, for a 90-cent credit. If we're able to get in, we're going to have an order to exit with gains if we can exit for 18 cents or less. That's our limit price. Or on the opposite, to the opposite extent, if we have to pay $1.80 to exit, we're just going to stop the bleeding. Yep, we've taken a loss. At least it's not $3. And I would send the order off from there. Now, I'm not actually going to place this order because I won't be around to follow up with it. This would go into my paperMoney portfolio, and I use this for my regular webcast series. But Brett's going to be back to have future discussions in this webcast series. It's his webcast series. But that's the process for entering a bull put spread with a plan for taking profits or a plan for taking losses. I would definitely be remiss. I'm not going to place those right now, but I would be remiss to not mention how this changes the probability scenario of the trade. When we're putting this trade on, with the original structure, here's our original reward, our original risk. This is a high probability trade right from the outset. We need the stock to be above 115 at expiration to be in our best position. It's already on day one above 15, so it doesn't actually need to do anything. As a matter of fact, it could fall a little bit, and it would still be above 115. So the probability of success, we already know, is above 50-50. The probability of failure is below 50-50 because to have our worst case outcome, we know that we need to be down below 112. Well, the stock is solidly above 112. Solidly, that's kind of too definitive a term. We can just say it's above 112 at this moment, right? It would have to go down. It might, but more likely it won't go down that far, or it'll go up from here. So the probability is in favor of this trade. But once we start to introduce, let's say, impatience, if the stock goes down a little bit, if it goes down far enough to introduce a 90-cent loss, we might be done, even without having gone below 112. It changes the probabilities of the trade, and it's not in the favor of the trade. Actually, the probability of loss goes up as the size of the loss goes down with that order that we just placed. I wanted to point that out. But guys, we've accomplished what we set out to do today. I just wanted to talk through building a custom chart strategy set for the planning and placing of vertical spreads. And today we talked about combining 3 linear regression lines. We talked about how those might identify trend and how they might identify support and resistance levels for potentially getting into, in this case, a bullish vertical spread. Yes, this is also sometimes used by traders for structuring bearish vertical spreads. Guys, I hope you enjoyed it. Time for me to let you go. Scott, thanks for helping out in the chat. As I turn you loose, there are definitely some other resources I just want to make you aware of the resources that are available to you from Schwab Education. Starting with, let's pop over here to the Trader Talks channel on YouTube. Those that are here in the live stream today probably already know you can watch our live streams through our YouTube channel. It's called Trader Talks Schwab Coaching Webcasts. So if you're new to this, make sure that you subscribe to our channel. Pop down below, click on the subscribe button. Doesn't cost anything. It only takes a second to do it. But you can join the live streams here on our channel. You can also find the playlist for previous webcasts. Another thing I would suggest you do is to follow your favorite Schwab presenters on social media. You can find us on X. You can find us on LinkedIn. For example, you can find Scott and me on X. Scott there is at Scott Thompson CS. You can find me on X at Cameron May CS. So there's my name. Here's my handle. And as I post on X, if you reply to my posts, I just try to reply right back to you. It allows for nice little communication when the camera's not on. But you can do the same thing over on LinkedIn. I post on LinkedIn regularly. And if you reply or you comment here, I just comment right back. Greg, glad you enjoyed that. Will, certainly my pleasure. Wacky Wack, thanks for watching. Mark, you're welcome. I will look for you guys in a future webcast, but I do want to say thank you to those that are in this one who have already given me a thumbs up. If you're watching live, or even if you're watching on the recording, anytime you enjoy one of our webcasts, give us a thumbs up. The way YouTube works is that means, hey, people like this webcast. We should show it to more people. So not only is it, a pat on the back to the presenter, it also gives my videos a nice boost in the YouTube algorithm, helps more people find them. All right, everybody, go have a great day. I'll look for you in those future webcasts. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish the very best of luck. Happy trading. Bye-bye.